In 1929, Joseph Kennedy exited the market months before the Great Crash. In 2008, Michael Burry bet against the housing market and made a fortune. These were not random acts of luck. They were moves in a financial pattern that repeats with mechanical precision. It is a four-stage sequence that a small group of investors follows to profit from the inevitable cycles of boom and bust. Today, in 2025, the echoes of this pattern are all around us. Let's explore the blueprint they use, a blueprint hidden in plain sight. Stage 1. The quiet exit. This begins 12 to 18 months before a crash, while markets are still climbing and optimism is high. Sophisticated investors start selling, not because they know the exact date of the fall, but because they recognize that risk has begun to outweigh reward. The famous story tells of Joseph Kennedy deciding to sell after his shoeshine boy started offering him stock tips. He reasoned that if everyone was in the market, there was nobody left to buy.
The modern echo? Warren Buffett is sitting on the largest cash pile in market history, over $300 billion, claiming he can find nothing attractively priced. Corporate insiders are selling their own company stocks at rates not seen since just before the 2008 crisis. Stage 1 is the art of leaving the party while the music is still playing. Stage 2. Insuring against the storm. 6 to 12 months before the crash, these investors move from passive selling to active protection. They buy insurance. In modern finance, this means instruments that pay out only if the market falls. In 2005, Michael Burry looked at the U.S. housing market and saw a bubble built on toxic mortgages. He couldn't short the houses, so he persuaded investment banks to create a new tool for him, the credit default swap. It was an insurance policy against mortgage bond failure. For 2 years he paid premiums, losing money month after month as the bubble inflated. His own investors called him insane. But he understood that you buy insurance when the skies are still clear. When the storm hit in 2008, his policies yielded hundreds of millions of dollars. Stage 3. The precision strike. This is the most aggressive phase, beginning 3 to 6 months out. It involves actively betting against the weakest link in the chain, not the entire market, but the specific sectors that will crumble first. In 2007, investor John Paulson didn't just bet against the housing market. He identified the specific financial firms, like Bear Stearns and Lehman Brothers, that were most exposed to the bad loans. While Wall Street rated them as buys, Paulson saw they were technically insolvent. When they collapsed, his funds made billions. Today, the most vulnerable sectors appear to be commercial real estate and the regional banks that finance it. With office buildings sitting half empty and trillions in loans needing to be refinanced at triple the old interest rates, hedge funds are quietly building massive short positions. They are targeting the epicenter of the next potential earthquake. Stage 4. Buying the ashes. This is the final act. It occurs at the moment of maximum fear, when panic is absolute and everyone else is selling. This is where generational wealth is created. In the depths of the 2008 crisis, when Lehman Brothers had just failed and the global financial system was on the brink, Warren Buffett made his move. He invested $5 billion into Goldman Sachs, a bank desperate for capital. He was not buying into the panic, he was buying into the fear itself, securing terms that were immensely profitable. Today, private equity firms are sitting on hundreds of billions in so-called dry powder, capital raised and waiting. They are not waiting for the market to go up. They are waiting for stage 4. For the opportunity to buy premium assets, buildings, companies, technologies, at fire sale prices from those forced to sell. Exit, insure, strike, buy. This 4-stage pattern is not a conspiracy. It is a framework for navigating financial history, rooted in market mechanics and human psychology.
Bubbles inflate with greed, and they burst with fear. So how does a regular person navigate this cycle? Understanding the pattern is the first step. For a prudent investor, this knowledge doesn't suggest panic, but preparation. This might involve increasing cash reserves in a portfolio to have capital when assets become cheap. It could also mean exploring protective instruments. Most importantly, it means preparing for stage 4. Creating a list of quality companies you'd want to own at a deep discount when fear dominates the markets. We see the stages playing out now. The quiet exit of insiders, the rising cost of market insurance, and the targeted bets against vulnerable sectors. This historical rhythm suggests that stage 4, the buying opportunity of a lifetime, is not a question of if, but when. And that makes all the difference. Before, this mechanism was their advantage. Now, it is known to you. You see the same stages, you understand the same logic. You are no longer just an observer. You are prepared.